Have you ever looked at the stock market and just thought, why is it so jumpy? One day it's up, the next it's down, and a lot of the time there's no obvious reason why. Well, it turns out that's not just you wondering. That question is actually one of the biggest puzzles in all of modern finance. So let's dive in and try to figure out why prices might move, well, way more than you think. All right, here's the plan. First, we're going to look at the classic theory, how prices should behave in a perfect world. Then we'll see how real-world data completely blew that up with something called the excess volatility puzzle. From there, we'll unpack the two big explanations that popped up, one all about rationality, the other about human psychology. And finally, we'll see how this one puzzle completely changed the game for the entire field of finance. Okay, so to really get this puzzle, we have to start with the big idea that for decades was the foundation of financial economics. What is a price actually supposed to represent?
So the core idea is actually pretty straightforward. A stock's price today is supposed to be nothing more than the value of all the future cash it's expected to give back to its owners. Its dividends. You just take all those future payments and discount them back to what they're worth right now. The point is, the value is anchored to something real, the company's power to make actual money.
Okay, so follow the logic here. If a company's dividend payments are fairly stable and don't jump around wildly, then its stock price should be pretty stable too. This makes perfect sense, right? The price should only really move when some new information comes out that forces us to change our forecast for those future dividends. This isn't just some abstract theory. It's what you logically expect in a rational market.
But what happens when you smash that really elegant theory against the messy, chaotic reality of the stock market? Well, that's where it gets really interesting.
So this was the big showdown. Researchers decided to put the theory to the test. They took decades of stock price data and laid it right next to the actual real-life dividends that companies paid out later on. The question was simple. Did the crazy price swings we see in the market actually line up with real changes in the business? And the answer? Oh, it was a huge, resounding no. What they found was, honestly, a little shocking for the entire field. Stock prices were jumping all over the place, way, way more than the actual dividends were. The swings were just too big to be explained by news about future profits. This wasn't some tiny rounding error. It was a giant hole in the theory. Yeah, this was a direct shot at the idea of a perfectly rational market. As the source material puts it so well, the data basically screamed that markets were more unstable than the fundamentals themselves could possibly justify. You had this massive, undeniable gap between theory and reality. And just like that, one of the biggest intellectual headaches in finance was born. This chasm between the predicted calm and the observed chaos, well, it got a name, the excess volatility problem. And everybody knew it needed an explanation. So if the price swings are just too big, what in the world is going on? Well, the debate that exploded from this discovery basically split the world of finance into two major camps, each with a totally different way of looking at the market. And this slide lays out the two sides of the argument perfectly. On one side, you've got the behavioral view. This camp says, hey, the answer is psychology. Investors aren't perfect calculators. We overreact to news, and we get swept up in these waves of collective optimism and pessimism. The bottom line, emotion can drive the market. But then, on the other side, you've got the rational view. And this camp says, well, hold on. Maybe our model is just too simple. They argue it's not the future dividends that are changing so much, but the discount rate. That's the key. Think of the discount rate as how scared investors are of risk. If that fear level is constantly changing, then the return they demand for taking on that risk also changes. And that can make prices swing like crazy, even if the business fundamentals are rock solid. And what this debate really uncovered was something much deeper. See, the idea of an efficient market doesn't just depend on prices reflecting information. It also depends on investors pricing risk in a stable, consistent way. If that discount factor holds steady, then yeah, all that extra volatility looks irrational. But if the discount factor itself is bouncing all over the place, then maybe, just maybe, all that volatility is perfectly rational after all.
Ultimately, the excess volatility puzzle was a total game changer. It blew the door wide open for what we now call behavioral economics. For the first time ever, mainstream finance had to get serious about the idea that human psychology might be just as important as all their clean structural models when it comes to explaining how markets actually work.
So what was the real fallout from this huge intellectual battle? I mean, this wasn't just some boring academic squabble. It completely changed our understanding of what makes markets tick. Let's break down the legacy of this puzzle. I mean, the impact was huge. First, it cracked open that old question, are markets really rational? It completely challenged the easy assumption that all volatility is just the market rationally adjusting to new information. And, like we said, it forced the entire field to take psychology seriously, which directly paved the way for the rise of behavioral finance as we know it today. Okay, but here's a super important final thought. Just because prices are extra volatile, that doesn't automatically mean the market is inefficient. And why's that? Well, because real inefficiency means you can predictably make money from it. A market can be totally wild, driven by fear one day and greed the next, but if you can't consistently beat it, then in a practical sense, it's still efficient. It's a tricky but really important distinction. And this really brings us to the final profound shift in thinking. The whole puzzle moves us away from just asking, are prices rational? That's almost too simple. Instead, it forces us to ask a much more interesting, more real-world question. Can rational traders enforce rational prices? In other words, even if some prices go nuts, are there enough smart, well-funded people out there to actually correct the mistake? And that question, about the real-world limits of keeping markets sane, is exactly where the story of finance goes next.